Welcome to the AICA conference in New York City. I'm Jane King. With me is Vlad Bulkin with the Katten law firm. And so you're kind of a different perspective than some people I've talked to. Tell me what it is you do exactly.
Sure. I'm a lawyer who focuses on business development companies, or BDCs. I work with the formation, capital raising, and dealing with all the regulatory issues that come with managing a BDC, both on the issuer side and underwriter side.
Okay. So you're kind of on the ground floor with these BDCs. What are you seeing in terms of trends, interest? What do you see?
Well, as you may know, private credit has been a huge growing industry, and a BDC is a very attractive wrapper for a BDC manager to raise capital. It could be used to access retail channels for raising capital. It could be also a very tax-efficient vehicle for raising capital outside the U.S. More recently, there's been a proliferation of privately offered BDCs. There's been some regulatory changes lately that allow a privately offered BDC to apply and receive exemptive relief to have multiple class of shares, which the default is under the Investment Company Act is that you can only have one class of equity shares. So if you can get this exemptive relief, you can offer different classes to different types of investors all within one vehicle instead of having to raise different vehicles for different type of investor bases.
When you say class of shares, I think common stock, preferred stock, is that what you're talking about?
No, I'm talking about multiple types of common stocks.
Oh.
So Class A, Class B, a class for just institutional investors of common stock, a class for maybe accredited investors of common stock, and then a class for non-accredited investors of common stock. And they each come with different distribution fees, different sales loads. And for a long time, if you wanted to sell different channels, you would have to set up multiple BDCs. Mm-hmm. Then came along what are called non-traded or publicly registered but not listed BDCs. They were able to get exemptive relief to issue this about 10-ish years ago. But privately offered BDCs were not. And just recently, at the beginning of this year, the SEC has started granting relief that any non-listed BDC can apply and receive multi-class relief. So privately offered and registered.
Now, are you finding there's more interest in that? And what would be the benefit of being private?
Well, you don't have to be subject to the market volatility of
all the filings.
You're still making all the filings.
Okay.
So when you're elect to be regulated as a BDC, you also have to register under the 34 Act. The 34 Act is the one that requires you to make all the quarterly and annual filings. So you're still making all the filings, but many people find it easier to start or launch a BDC by raising money privately, build a track record, and then eventually take the BDC public potentially as a exit event. So that's been the trend lately, that many managers start privately, whether it be registered but not listed or just really private. They raise money privately and they grow, they show a track record. And it's when the markets are compliant or, attractive or open, they launch an IPO and it lists. Or they could do a direct listing.
And then retail investors who are interested in investing in private, how can they do that? How does that typically happen?
So right now you would get access to that through your financial advisor. If you're part of a RIA family or some kind of broker-dealer where you can buy through them, you can purchase registered non-listed BDC shares that are offered through RIA channels, wirehouses.
Yeah. Okay. Interesting, Vlad. Thank you so much.
Thank you.
Thanks.